a food processor that has 1 million square foot
Yeah.
facility. The reason that that property is so hard to value is that there are some very unique fixtures that would be part of running a cold storage and chilled area type food processor, for instance, like an ice cream factory,
Yeah.
right? And a lot of those components are permanently affixed. And so, depending on the state that you are in, that property may have components of a fixed property that would not or should not be taxed with the real estate,
Right.
right? But in other states, they would. And so, how in the world would a corporate controller even understand what
The
to
intricacies.
include on
Yeah.
their business personal property tax filing if they can't readily determine what should be taxed only as.
Welcome to AFO Wealth Management Forward, a podcast powered by Arrowroot Family Office that's at the intersection of accounting, wealth management, behavioral finance, technology, and entrepreneurship. We help accounting firms and financial advisors grow their practice by going beyond the numbers as we learn from industry leaders and subject matter experts to discover the secret to their success. A podcast that highlights everything from the transformative power of AI to embracing the human-first approach of behavioral finance to help you understand the psychological and emotional relationships to money and meaning. Here is your host, Rory Henry, Director at Arrowroot Family Office and author of Holistic Guide to Wealth Management.
All right. Hello, everyone. I have another great guest joining me today. He's the president of JM Tax Advocates, a state property tax firm where he helps businesses save potentially hundreds of millions of dollars through secured property tax reductions and economic incentives. We're here to talk about property tax and property tax management. So without further ado, let me introduce our guest, Josh Malancuk. Josh, welcome to the show.
Thanks, Rory. Yeah, I appreciate the opportunity to be here.
Yes, I found this to be a very interesting topic because most people, when they get a tax bill, especially if it's a property tax bill, they just go ahead and pay it. So before we kind of get in the nuts and bolts here, because like I said, I'm fascinated by the process and the work you do over there. Let's go ahead and give our audience a little bit of background on yourself and what led you into this specialized tax business.
Yeah, so the first part of my career, Rory, I spent working in the throes of public accounting, right? Majored in that accounting degree with Indiana University, a top 10, accounting school in the United States, and went to work in the audit function for a large regional firm, and got bored in a hurry. And it was just a grind, a lot of hours, a lot of travel, just low pay increases every year, and it just wasn't the kind of existence that got me excited to get out of bed every day. And so right about 2-3 years into my career, the firm that I was working for actually bought out a boutique state and local tax consulting firm, which is kind of the norm. If a firm doesn't have the experience in-house, they'll just go buy it, right? So this one did that. And they had a gap with their property tax group. And so meanwhile, I had been preparing property tax return filings to keep my utilization up, to keep the utilization police off my back, right? And so I knew what a business personal property tax return was, which is the return that you'd report, your equipment, your inventory, your FF&E and all that. And so I thought, well, what the heck, in a matter of months, I'm going to be looking for a job completely different than this one that I'm in. So I gave it a shot, really was fascinated with the review and the function and the consulting learning, and was able to really position and really reinvent my career in public accounting with really an emerging area that I found no one really had a great answer for, but for some of these specialists, right? And so, as you're suggesting, most of the clientele before they hired my firm and hired me to be involved with their review and their business, they were just paying the bill,
Yeah.
no questioning.
No questions.
And so, it's just interesting, studying, how to review and the trigger points and the interesting ways to benchmark and discover errors.
Yeah.
Came from some fantastic mentoring from a lot of these firms. And very quickly, I became an expert in the field. And so now, 28 years later, I've seen a lot of things. I know a lot more than I did when I first started out. And so depending on, the type of industry or the client property type, I can quickly diagnose errors that were either made by the business with their return reporting on the business personal property taxes, or on the valuation side, discover whether the assessor has captured the fair market value with assessed value, and whether an appeal should be filed for that property as a result of overage with the assessment levels.
Yeah, let's talk about those assessments, because I know there's a couple ways to assess the property there, and then I know when you get the notices in the mail that you have a certain matter of time to appeal that. Let's talk about kind of the process on how this all works here, Josh, because I know they don't leave you a lot of time to appeal, which makes a lot of sense. It's the county and state municipalities. They need that tax money. So let's talk about, kind of the foundational steps here on the assessment to that appeals process as well.
Are you an accountant looking to generate more revenue and secure your future success as automation and artificial intelligence revolutionize the accounting profession? If so, contact us at AFO Wealth Management Forward. We specialize in helping accountants and advisors just like you build a custom brand to pinpoint your optimal clientele, generate highly qualified leads through our data-driven digital marketing, and execute wealth management growth services to bring more value to your firm and your client's life. Our strategic approach to branding, marketing, and wealth management is carefully tailored to attract ideal clients, increase customer retention rates, and cultivate lasting relationships with clients across generations. Visit wealthmanagementforward.com to book your free consultation to find out how you can elevate your practice.
Well, Rory, what I would say as a starting point is that the entire system is rigged for failure for any business trying to do a do-it-yourself approach with these tax appeals, and I'll explain why. But yes, the first step is knowing your deadline, and that deadline can vary by county, by state, even by city within the county, and so being able to track when notices are coming out and the appeal procedures that are required to not only file an appeal, but to keep your appeal alive and kicking through evidentiary building and disclosure. Those are very important steps and wrought with pitfalls right along the way. And so if you miss any one of those steps, it can either hinder your ability to even make an argument or torpedo your entire appeal altogether. And so what you don't want to have happen is to file an appeal and then also have a nice little surprise, namely, has the assessor undervalued your property? And now you've kicked the bear, and now you're facing a property tax increase because you didn't know how to value your property correctly. And that skill is extremely important in my world, right? And so one of the aspects of my background that I didn't share is that not only did I go through the painstaking effort to become a CPA in my state, but I also, along my 28-year career, went through an extensive training and curriculum and education to become a certified general fee appraiser as well. And so, I know how to estimate value for many different property types as a result of that training. And I can also review appraisal reports and understand whether that appraiser has hit the mark with their valuation support, because I've seen it a lot of times, and I've actually created physical, reports that were hundreds of pages in length just to qualify and gain my license. And so what we're able to do as part of our approach is step one, once we find out that the assessor has sent out their notices or that there's a deadline out there, we can do a mini appraisal, if you will, to determine whether that property is fairly assessed, underassessed, or overassessed. And so we're coming in with eyes wide open, with at least an initial foundation to file that appeal. And so that includes the market analysis, that includes some research of public records, and we're coming at this with an informed approach. So we're not going to have that surprise with a potential increase in property tax.
Yeah, Josh, I was listening to another one of your podcasts, and I think it'd be good for our audience to maybe have a use case here, because I think you were stating that, you have these big corporations potentially going into these smaller towns, a Tesla, for instance, and there's not a lot of comps out there that you can that you can measure against when they're going in there and developing these new factories. So can you kind of talk about maybe a use case here and the issues around the valuations?
Yeah, so probably one of the most difficult properties to value in general are the properties that have a limited market. In other words, you're lucky to see a transaction with that property type and that size of property in maybe a 10-year period, right? And that's covering the entire United States. And so you get into, let's just say, for instance, a food processor that has 1 million square foot facility. The reason that property is so hard to value is that there are some very unique fixtures that would be part of running a cold storage and chilled area type food processor, for instance, like an ice cream factory, right? And a lot of those components are permanently affixed. And so depending on the state that you are in, that property may have components of a fixed property that would not or should not be taxed with the real estate, right? But in other states, they would. And so how in the world would a corporate controller even understand what to include on their business personal property tax filing if they can't readily determine what should be taxed only as real estate and what should be taxed only as business personal property? That's a really challenging question to answer. And so because we've seen that property type and we understand how certain items should or should not be valued, we can drill down to that answer very quickly because of our experience, right? Meanwhile, the assessor may only have a high school education or a GED equivalent with no appraisal background whatsoever. And so finding comparable sales, in other words, sales that physically look similar to the subject, maybe are in a similar age range on construction date or dates, similar ceiling height, land size, similar markets. If it's a small town, your land is not worth nearly as much as in a big city. And so finding comparable transactions of physically similar property types that economically transact with cash dollars and not as a business going concern, that is almost impossible to do, and to correctly interpret those sales to correlate that back to fair market value for the subject property real estate. And so in the case of that property type, the assessment is almost always wrong. I would say over 50% of the time or greater, there is a material difference between the correct fair market value of the real estate and what is being assessed.
Yeah. What are some of the other pitfalls here that you run into when working with these assessments?
Well, so one of the other pitfalls is where the assessors try to seek for an increase in value
Mhm.
because they want you to go away as
Yeah.
a taxpayer, right? And so having an advocate that understands how to kind of combat or offset some of that data and
Right.
bring better facts together, that can be a very valuable aspect to uh, having a qualified seasoned navigator involved with that tax appeal. Because at that point, if you can't rebut with better evidence as a controller or CFO, that appeal
Yeah.
that you've started, you're probably just going to withdraw and hope that the assessor does a cease and desist and doesn't, and so you don't have to explain an increase to your
Yeah.
boss, right? Whereas with us, we're going to respond to that evidence with better evidence and with a rebuttal that is sound and is based upon market value concepts that should be reviewed and adhered to by any local or state board as a result of their review of the overall tax appeal.
Yeah, because I'm just there's seems like a rabbit hole you can go down, because when you look at market value comparables, there may be properties that were sold, but the businesses were sold with the real estate. So you have the intangible value, the enterprise goodwill of that business that's basically being bundled with the actual real estate component. Is that something that you run into with these market valuations?
Well, Rory, you hit on a really good topic because certain property types almost always transact as a
As a
business,
business? Yeah.
never as just vacant real estate,
Right.
right?
Right.
For instance, you get a senior care property, a skilled nursing or an assisted living facility.
Yeah.
If that one sells, it's selling as a business. And so what does that mean? Well, you're basically selling the real estate. You're selling the equipment within the four walls
Right.
or however many walls there are, right? And then you're also selling an intangible aspect. In other words, the business know-how to
Yep.
operate that license and maintain the license so that you can actually maintain compliance with state service standards, on a state by state basis. And that management know-how is extremely important. In fact, it's integral
Yeah.
to maintaining that ongoing business. And so the management intangible is absolutely huge. There are typically services that go well beyond just the rent that the
Yeah.
occupants are paying, such as paying for a licensed occupational therapist or physical therapist or an on-call nurse or someone that can actually deal with memory loss with Alzheimer's. I mean, there's a lot of different services that go into operating these property types, and you got to know what you're doing as a management team to operate that team
Yeah.
in a unified fashion to maintain your service standards. And so that definitely represents an intangible aspect that should be recognized. But how often do I see an assessor chase a transaction of, say, $130,000 a bed, and just to come find out that a third of that value was for intangible,
Yeah.
and maybe another 10% was for the FF&E, business personal property. And so all of these non-realty elements were bundled up as part of that sale. And unless you have someone with valuation background like we have, they're not going to know how to unbundle all of those elements and develop a credible argument for why the real estate should be valued at maybe $70,000 per unit instead of that 130.
I can see it now. And the assessors, many times don't have the expertise. The CPAs many times don't have the valuation expertise. So that's where you can go in there and kind of put the pieces of the puzzle together. Let's kind of go further into this now. You got my wheel spinning here, Josh, because and I was listening to some other podcast episodes you're on. What other types of businesses do you get called into? I think you talked about utility companies. I mean, we're looking at like hundreds of millions of dollars in real estate, values here. Can you kind of talk about the types of businesses that are best suited for this type of work?
Well, yeah, so utility companies pay a ginormous property tax
Right.
bill, but it's actually mostly related to their power generation equipment. And so most of their property tax is related to business personal property.
Mm,
So you have all their power generation lines that are disseminating the power. You've got their generation stations that are manufacturing the
yeah.
electric power. And then you've also got the administrative areas where they are housing their administrative folks and their maintenance crew
Yeah.
to be able to repair their on-site vehicles. And so all of that kind of bundles together in this massive property tax bill because of all of the hundreds of millions, maybe billions of dollars
Yeah.
in property that it takes to actually manufacture electricity. It's just really fascinating to understand how an electric utility company operates and the massive capital that goes into to one of those businesses. But so they're always a great fit for examining property taxes just simply because they pay so much. But
Yeah.
industrial manufacturers, their pound of flesh typically is with that business equipment tax if they're taxed on their manufacturing equipment, but then they have a big footprint. And so again, they're paying a good real estate bill because of the size of the real estate and the land holdings that they have. The senior care properties, so independent living, assisted living, skilled nursing sites, they have a big footprint, pretty valuable property. They're nice properties.
Yeah.
They cost a lot to build, and so by default they're going to pay a pretty hefty sum for real estate tax, and they'll have multiple sites to accommodate kind of the age of life from independent living all the way to skilled nursing to accommodate their guest needs as they're aging. Hotels, especially resorts, the resorts can pay millions of dollars in property
Yeah.
taxes. And what a challenging property to value if you're an assessor, because
Yeah.
again, you've got an intangible wrapped up into that flag
The
and to the
flagship. Yeah.
management. And so when one of those properties sells, it's usually as an ongoing business, hopefully.
Yeah.
And if it sells, it's usually a portfolio sale. And
Yeah.
so, uncovering and unbundling the portfolio influence is really challenging. And again, where there's challenge, it creates complexity for an assessor and then a higher likelihood of property tax overage and the need for a seasoned navigator to be involved to make sense of it all, right?
Yeah. Yeah.
And then the other area or property type that we see a huge opportunity for these days because all of the remote worker uh, phenomenon
Yeah.
as a trend are office properties.
Uh,
And again, the bigger the office property, the harder it is to occupy. And so, you get a corporate headquarters. We literally have a client with a corporate headquarters that at one time had 2,000 bodies
yeah.
at their site. It's down to 200.
Yeah.
I
So
kid
everything's
you not.
repriced. Yeah.
90% down. And it's going to be a tremendous undertaking for them to find a buyer for that property if they decide that they just don't need that space anymore and they'll just go out and rent a space that can accommodate 200 heads, right? And so the office properties, especially the national headquarters,
Yeah.
they're taking a huge hit on their market values. And because the properties are so costly to build, chances are the assessors are not only overassessed, but way overassessed and have not dealt with all of the myriad of issues. And so they could literally have 50% to 70% overage on their valuations simply because of this extreme blight on that property type that's happening these days because the consumer.
Yeah. Yeah. That makes total sense. Now, I was reading your Accounting Today article, and I think it'd be great for our audience if you could share some of those top strategies that you had in that article to really show how they can successfully have some tax savings here, Josh.
Yeah, so yeah, that article had to do with workforce and workforce strategies
Yeah.
for growing businesses, right? And so in that area it can spill over into a property tax situation, right? Because when you negotiate economic incentives, part of that benefit can come through local property tax relief, at least on a temporary basis. And so instead of paying all the property tax all at once as a result of promising growth and delivering
Yeah.
growth, you can abate that property tax over a period of time. Maybe it's 10 years or so, and then you're basically in a relief position for a longer period of time. And so with incentives, what that basically entails is, as an employer, you're committing to grow your headcount and invest in capital. And as a result of the growth and what you're promising, the locals and or the state will actually induce you to grow. And so it ends up being a partnership where essentially the state and or the local economic development agencies
Mhm.
are paying for those jobs,
Yeah.
right? They're buying those jobs because you're literally competing with other sites or other locations for those same jobs and for that investment in capital. And so, because when capital expansion happens, the economic development planners know that it will have an economic impact with folks moving into the community,
Mhm.
with contractors coming in and funding money into restaurants for lunch and meals, and maybe moving in as full-time contractors to support that site. And so um, that's why these local and state sites want to grow jobs and want to grow capital expansion opportunities to develop the economy. And so knowing how to plan that as a business is
Mhm.
extremely important, because let's just say company X has an epiphany. Hey, I need to grow. I've got orders, more orders than I know what to do with, and I'm beyond capacity. So I
Yeah.
have to look at another site because I'm out of labor at this site. So now there's a site selection to figure out, where do I need to be in proximity to my major customers and transportation linkages, and where does it make economic sense to grow maybe a new factory or grow jobs or both. And so at that point, if the company doesn't engage a seasoned navigator and just again does a do-it-yourself approach to negotiate those incentives,
Yeah.
they will likely disqualify themselves from, at the very least, a maximum benefit incentive, or possibly for the entire incentive itself, because there's specific steps that you have to undertake to create this perception that you would not have grown at that site but for the incentives that were negotiated well ahead of construction permitting,
Yeah.
announcements, actually hiring those jobs, installing the capital, digging dirt
Yeah.
where girders are up out of the ground. I mean, I've literally been in front of councils before when my client forgot to tell me the construction crew had rolled in and there were girders sticking up on the ground. And, they quickly pointed out that we should have started maybe a few months ago with asking them for incentives. And so you don't want to have those uncomfortable moments as a company where you realize, gosh, I should have planned well earlier than this,
Yeah.
and now I've lost out on millions of dollars in incentives because of that negotiation process that's so important.
Yeah. So it's a planning type of process, and it's also making sure you have an appeal if you feel that you've overpaid. What are some telltale signs that you may be overpaying on these property taxes, Josh?
Well, let me first start by saying the way is not to look at your tax bill increase, okay? Because you cannot appeal the tax, and
Yeah.
that's the common misunderstanding with any
It's the
company
valuation,
official.
right? Yeah.
It's you can appeal your assessed value.
Yeah.
You cannot appeal that tax rate. And so if your taxes increase, that doesn't necessarily mean that you're overvalued. What you have to look at is whether the assessed fair market value is in line with the actual market value. And how do you do that? Well, there's a lot of different techniques from an appraisal standpoint to figure that question out. And in some cases, you're looking at transactional sales of similar property types in and around the area of the property. In other cases, you're looking at what the market income would be
Yeah.
relative to ongoing cap rates. In
Yeah.
other cases, you're looking at what would be the answer to build the property in today's construction standards, and then applying valuation depreciation methods that are extracted from the
Yeah.
market. And that all rolls up to a pretty darn complicated analysis.
Yeah.
And one that doesn't have that appraisal background is just not
Yeah.
going to be able to hit the mark, right?
Yeah. I get it. I get it. All right, Josh, this has been fantastic. I know those in the audience, if they have these issues, they're going to want to learn more. How would they be able to reach out to you? What's the best way and get in touch with you?
And so my email address, Rory, is joshua@jmtaxadvocates.com. My telephone number is 317-863, scratch that, 317-514-4602. Either way is a great way to get a hold of me. The last number is my cell phone. And so feel free to reach out. We're always happy to help with an initial evaluation to get to know our client. And we'll actually qualify our client for property tax relief so that we're making a good use of our client's time and a good use of our time. And so we'll know that there's money to chase before we ever endeavor in filing any tax appeals or amended returns. And so the other aspect that I would say, Rory, is that we almost always work on a contingency fee. And so,
nice.
Unless we save money for a business, there's no fee. So it's simple. It's a simple way to work together. And we kind of put our money where our mouth is with our fee approach.
I like
And
it.
it really works well. And it's a very easy cost benefit business decision for any CFO or controller to hire us on a contingency fee so that, we're performing, we're being compensated with the savings, and then the rest is just added back to the bottom line with profits to the company.
Yeah, you would think that we have to somehow align incentives for people to actually, reach out and get this done. Is there ways for owners out there, or people that are listening that are owners, to incentivize their employees to be looking out for this, type of issue?
Well, so if I'm a controller or I'm a CFO and I'm, riding on performance improvement with their profit and loss statement to generate bonuses and compensation, I'm worried about property tax.
Yeah.
Because it's a huge property tax. It's a huge burden to a business, especially a capital intensive burden business type, such as a manufacturer or some of these other types that we've mentioned. And so I've got skin in the game. And I just may not know that I can move the needle south with this operating cost area. And rest assured, we can, but you've got to hire a seasoned navigator. We certainly are seasoned, and we certainly can help navigate. And we've got the worst stories to prove that out. But whether you hire us or anyone else, you don't want to ignore property tax.
Yeah.
It's an ongoing burden.
Yeah.
And the overage is not going to go away unless you have a thorough review with an experienced expert that knows what to look for, knows how to hit that locomotive the right way to get it to move forward, and can help you avoid surprises that might come about through the inexperience that we mentioned earlier in the presentation.
I love it. I love it. All right, Josh, thank you so much for sharing your wisdom here with the audience. Hopefully we'll be in touch again.
All right. Thanks so much, Rory.
Thanks, Josh.
It's a pleasure.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.